Hey everyone, hopefully you're having a good day. My name's Andy, my channel is Finding Value. What I've got behind me is the Finding Value donations portfolio. If you want to contribute to the donations portfolio, I've got a PayPal link below. You can do that if you'd like. That is what's funding this portfolio. This is what is providing, I'll call it the education for everybody, is using the funds, and I'm kind of going to describe what's going on with the portfolio, how I'm setting it up, how I'm position sizing, when I'm buying, where I'm buying, why I'm buying, all those things. And a lot of people, there's two, I'll call it two major things to invest in my opinion. The two major things is to identify where value is in pricing assets. Like that's big. The other one is what vehicles do you use to take advantage of that mispricing of an asset. So if it's a commodity, then and you have vehicles to make money with the commodity, how do you determine what's a good vehicle to use? How do you determine which company is good? How do you determine what sectors may be good? And what I'm doing is I'm combining all of it. I think I'm doing a pretty good job of combining all of those things. And you also have to keep in mind that I'm not trading these companies. I am using them as investments, and I have to appropriately choose companies that everyone can use. I'm not going to be going after short squeeze companies all the time. I'm going to have some that aren't as volatile. I'll have some that are more volatile. And when I talk about companies in the speculative type movements, I'm going to have some of those in this portfolio. I'm going to have some that are not. What I'm looking for are large chart patterns that look very good, that are going to break these patterns or have broken the patterns and move to the upside with some sort of statistical probability in our favor. And we're choosing these companies in sectors that are undervalued, that are going to appreciate against other assets. Commodities are undervalued. They're going to appreciate against other assets like stocks and real estate and everything else. I think it's going to do very well over the next few years at least, maybe even up to 10 years. We'll see. Now, the companies I have in here are more mid-cap based. Mid-cap means that they've got the pop to the upside, but they don't have the ultimate pop. And when they go down, some of them, they've got production usually. They've got maybe some development of mines in the pipeline, or they're doing some exploration. So it's a good size company where they're producing. They've got maybe a development of a mine, and maybe they've got some exploration going on, or something that they're doing that's proving reserves around their mine, where they can expand the mine further. Companies like an AG, EXK, ACH is a behemoth there. We've got BTU, which is a coal company. They're all kind of the mid-cap type companies that I'm basically populated first. So the first thing I did was I said, what are some good companies that will capture the move? And I wanted kind of the small to mid-cap companies. Those companies are what populated the portfolio first. So a company like ACH, that's a little bit larger company. But AG, mid-cap, BTU, kind of a mid-cap, CDE, CDEV, Denison Mines, they're all smaller to mid-cap companies. I'm not going after micro-caps or anything like that. Now, Fuel Cell is more of a speculative play. I'm using more of my technical analysis background. I'm looking at the sector, renewables and solar and stuff. And that's a hydrogen fuel cell company. It is speculative. It's not a value play. But I can tell you this. Fuel cell has a lot of pop, a lot. And I'll show you what I mean by that. So I'm going to go to fuel cell real quick. And what I'm looking at here is I'm going to back up. Now, this move from the bottom here was from 24 cents to $29. And it did it at a bottom of 2019 to 2021 in about a 2-year time frame. Now, what is that on a bagger basis? Because I'm kind of interested on what that is. So 24 cents to $26 or so. 26 divided by 0.24 is 108 bagger in 2 years. 108 baggers. So when you're looking at this, what I'm looking at is it's a huge opportunity potential. And what I'm seeing here is we've got a pull down move. We come on down here. Let me get out of log. Here. We've got a pull down move here. We came all the way down, and it's doing what I consider to be that double booty bottom. it's a reliable chart pattern. Everything looks like, sorry guys for not removing me. It looks like a double, that double booty bottom, and we're right at the bottom, breaking this pattern right now. So now is the go time, and we got this bullish engulfing. So what this is doing is it's providing a fractal, almost, a potential almost move that could move to the upside. There could be a very big move in this thing. Is it guaranteed? No, it's not. It's a speculative play. So I'm looking at what the potential could be. This we'll call it the squeeze out of this orange could be a flood. It could be a tsunami. It could be a very big move. And I can afford to put a certain percentage of the portfolio in it for that type of move. And if I were to zoom back out and look at my percentages here, fuel cell is 7% of the portfolio. So I'm kind of, at this point, kind of pushing the limits. And that's my choice to do that. And I'm using my technical background to hopefully lean on that. FSM, Helix, these are all value plays. They're all commodity energy service company. Fortuna Silver Mine is a kind of a mid-cap silver company. Intrepid Potash is a mid-cap fertilizer company. And these charts all look really good. Centrus Energy, more of a speculative type play, I would say. Noble Energy and all these other ones, mid-caps. Now, what else did I buy? I added a little bit more into Seed. Seed is a Chinese company that is in agriculture and is doing GMO seeds, genetically modified organic seeds. I think that if we have a food crisis, China's going to have to obtain its own seeds. And they basically are backing, I think, this company, and it's already sold out of all of its product, and it's starting to ramp up more production of it. I think they're in a really good spot. And when you look at the pattern on it, and this is a more speculative play, it is. But this is where some money, I mean, could be a lot of money, could potentially be made. And we're looking at this, and I back out here. And this is another thing that gets me pretty drawn to it. It's only a 50 million market cap. So let me get myself out of here real quick. We've got that double booty bottom. What we do is we come in, that's one, and then you do your double booty, and then we break and go. This has gone all the way up at $175. We're sitting here at $842, kind of at the bottom of this move. So everything is in check. We got positive signals on the bullish engulfing, the big up days, small down day pullbacks, and I like it right here. That's me. Now I'm using some money to speculate on it for a potential move higher. I'm putting some speculative plays in this portfolio. So if you guys are more into the speculative type thing, you know what? I think that looks pretty good. And there could be some good value here too. They could start making money here, I think, this year. And whenever you cross over from losing money to making money, I mean, the chart pattern looks like it looks like it could be a bottom here. So you know what? I put $100 in it, and that's probably 5% portfolio position. I also added into SOL, Renesola. So what did I do there? That position I bought earlier in the day, I saw it breaking out. I'm up 22% in one day. The company went up 30-something% in the day. It's a solar company. Solar looks really good right now. Now, I know I've been trashing solar a little bit and saying all these things, but you know what? The charts don't lie. We've got a nice big bullish engulfing here. Small little pullback. This thing looks like it's going higher. It went higher. Renesola, it went up 36.5% today. I bought it over here. I did the chart yesterday in the donations portfolio. I said, man, if this thing breaks, it's going to have a big old break. Well, it broke. Big old break here. A lot of the other companies also broke out. Very strong patterns in this, and money's flowing right into it. I think if we have an energy crisis, they're going to try to solve it with solar. So you know what? I'm going to have a little bit of money there. I'm not going to let my biases get in the way, guys. The last time I had major biases, I missed some opportunities in technology. I'm not a huge tech guy, but you know what? I'm a big energy guy. And if they're going to throw trillions of dollars at this, and if they can figure out solutions where individuals can use solar, you know what? I'll ride the train as long as I can. I'll just say that. So I don't want to get my biases to have me miss some of these. And I think I chose some of the um, largest leveraged companies to that move. FCEL, SUNW, and SOL. And I didn't buy any SUNW. I bought it in my portfolio a couple days ago, and it's gone up massively. It could see, I see a large wick at the bottom here, but I bought it like in this day here, and boom, 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 big move higher. But I'm just going to ride these, and I position size them correctly where I'm not going to get, sold out of it or anything. Another thing I wanted to talk about, and I was kind of talking with someone else about this, is the fundamentals show you a snapshot. It's kind of like looking at an NFL player. You look at the stats, and you can look at them on paper, right? You're looking at them at paper, and you're like, this company's either good, it's bad, or this person, you could say, oh, he's 6'6", 200 pounds, is he going to be a good guard? And you're like, well, on paper, he looks okay. And then you go watch him play. Watching him play is like looking at a chart. You're looking at the game and you're going, my Lord, this guy's got some pop. That's what I'm looking for. I'm looking for pop, and I'm looking for the fundamentals. The fundamentals are there, and yeah, they may look good, they may look bad. It depends what the future is. It depends what the commodity does. It depends on a lot of things. So the fundamentals are a snapshot in time that says, yes, we're good, or no, we're not. But it doesn't mean that that's going to be that way in the future. And what I'm looking for is, what are the players doing on the game field? If I'm looking at the chart, that's the game field. And it's a history of the interactions between the buyers and the sellers and what the game is being played in real life. So I'm looking at the game, I'm going, man, this thing's got some pop. It's going. Like everything in the world's fractal driven. So you get these big old moves up, and then the consolidation. And the moves lower and the moves upper are an indication of what the potential gains could be in the future. Doesn't guarantee anything. It just says it could be the potential. So what I'm looking for are these big types of moves and adding some into the portfolio. Will they all be successful? I don't know, but what I can do is set up a betting strategy. That strategy takes out some of the risk. So my position size takes out the risk, and my strategy reduces risk. So what am I talking about that? So position size, I usually position size things definitely under 10% of the portfolio in one position, maybe 5, 6, 7% if I want to take an overweight position. And I'm overweighting some of the speculative stuff because the moves could be so dramatic and the charts are just breaking out. So I'm kind of positioning out in a couple of them. Why am I doing the positioning out in a couple of them? Because if your upside is so gigantic and your downside's limited to only 100% of your money, then some of these, if I just catch 1 or 2 or 3, I mean, the rewards will be so big, it doesn't matter if I lose a position or two, even in its entirety. Because if you get a 10 bagger, I could lose one, and now it's just a 9 bagger, right? If I have 2 equal sized positions, I lose one completely, and I get a 10 bagger in the other one, I still made a so-called 9 bagger. if that makes sense. The position size will be so much, your portfolio will grow dramatically. And if you get a really big one, like a 100 bagger, then you're talking about life-changing, life-altering investments. And from $1,000 and you get 2 10 baggers, that's $1 million. Or a 100 bagger in one shot is $1 million. So that's life-changing to get 100 baggers. They're very rare and they're very hard, and you're going to have to do some speculation and take some risk. But I'm not saying to go take all your money and do that. What I did with the portfolio is I balanced it across a bunch of mid caps that I think will do well if the commodity does well and give you leverage to the commodity. Then you get these speculative ones, you sprinkle them in a little bit. And I'm doing that on purpose. And I'm looking for the ones that really have home run potential. I'm not looking for ones that it may go up, whatever. I'm looking for the fractals, and the fractals are those big moves. And I'm looking for things where things could get, short covering or short squeezed. Some of those kind of opportunities as well. They may or may not play out, and that's why I have the base of my money in lower risk things that I think will do well. Some of these could blow up. They could go down 90% quite quickly. So I want you guys to kind of understand how I'm setting this up, why I'm setting it up, the fractals associated with it, and identifying the companies, buying it off the bottom of those patterns, looking for the candlesticks for the big up days, the small down days. It has all of those characteristics. Now's the time to hit the highest risk button at the lowest risk time. So it's a way of managing risk is all of those things that I just described. It's spreading it out across a bunch of those things in ultra high asymmetric bets, looking at the chart pattern and buying it at a low chart pattern, looking for the chart break, buying the chart break, and then also looking at the candlestick patterns and ensuring that you've got the right big buying pressure, small selling pressure, and all those things combined together. If you combine it all together, you're basically buying it at what I would consider to be the lowest risk time possible that you can potentially do. Nothing guarantees that this will work, though. Nothing. It's just using statistics using the statistics and changing it to your favorability. It's favorable for your outcome. That's all you can do. That's all you can do. Now, I know a lot of people worry about recessions or portfolio that goes down. I'll say this: recessions are usually not very long-lived. So if you're going to have the mindset that you're always scared of a recession, I just don't think that's a good mindset to have. I'm very positive in nature. I look for the patterns. I have trust in some of these patterns, and that's how I look at things. It's from a positive perspective, and I look for positive indications in the charts before going into them. But if you're always looking at things and you're always worried about a recession, if it goes down 30%, it's not the end of the world. It's not the end of the world. What I did is I changed my viewpoint. I said, okay, if I get caught in something where I'm down 30%, some of these companies are so volatile that they will go down 50, 60% very quickly. I say, I'm going to go through it. Because if I go through it, I have time on my hands. If I'm buying good companies that are solid with good value, some of these are speculative, remember that. With good value, I can relax and not worry about it. I'm just trying to time my purchase as best I can, and I can wait for it to appreciate back again because it has good value. Now, if you're playing the game where you're going from short squeeze to short squeeze, you will get slaughtered at some point. And you're really going to have to manage your risk there. You're going to have to put stop losses. You're going to have to do that, especially if you're taking overly large position sizes in individual companies. Then you have to really manage your risk quite immensely, and it becomes very, very stressful, very stressful. Because if you're going to be holding these things overnight, anything can break that. Anything, any sort of news, war comes out, something happens, and it's like, man, the volatility is going to kill you, and there's nothing really that you can do to mitigate that. It's always there. On the long term, if you spread your bets out, you get the value, you get the ratios, you get all that stuff at your back, you choose the right size companies, you're not going for home runs in the entire portfolio, you reduce a little bit of your volatility, you spread out your risk, it's much less stressful, and you can ride it higher and accumulate over time. I don't know how some of these people, they must go crazy, because if you start accumulating enough wealth and you're in the millions of dollars, are you really moving that amount all over the place trying to win? I just see that as a disaster. That's how I see it. I want lower risk, higher probability bets where I can do this. And exchanging precious metals, maybe I can do that on the portfolio as well. Buy some physical metal, show you guys from a donations perspective, and maybe we can speculate in buying 1 ounce of platinum, and then I can do a swap of that platinum ounce and show you how that swap works. I can swap it with silver, maybe mid-cycle or something else, or gold or whatever it is, swap it to another metal and see how that works. And you guys get to see kind of how that happens. Let me know in the comments section if that sounds interesting as well. But I can show you how that works, and you guys can kind of see how that works. I don't know if I would camera or do that with the person there, but I can maybe give, like a printout or something of it, and show you kind of how it worked. But that's also another good way to play it, is through the ratio games of physical precious metals. That's a very low risk. You take away deflation, inflation. You take away absolutely all of the risk, third-party risk, management risk, nationalization risk. It all goes away. And then you can just swap your metals when the ratios are good, accumulating more metal with time. So that's another thing. You can look at some of my other videos on that, ratio swapping physical precious metals. And I've made a lot of good purchasing power gains doing that. If you guys like the content, give me a thumbs up. Subscribe to the channel if you haven't already. And thank you for listening. This is Finding Value.